a quiet start for the markets on the first trading session after that very disappointing jobs report on Friday. We don't ultimately go very far, at least as it touches the stock market. S&P 500 kind of idling here, a little bit higher, but ultimately not going anywhere relative to where it closed on Friday. A little bit of a nudge up for the NASDAQ as well, but also well within its familiar range. A lot more of a fireworks display still ongoing in gold and the bond market. So what are we going to do this week with the Fed looming just a week and a half from now? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we have no shortage of meaningful event risk that's on the board this week that can very potently influence expectations for what happens when the Fed does finally pull the trigger. So, is this going to be the calm before the storm? Maybe so. And by the way, that storm can be bullish, it can be bearish. We just know that the 17th is a major touch point for these markets one way or another. But will we have a sort of period of drift before? Well, maybe not, because the assortment on the calendar this week is, let us say, non-negligible. First, here's how we fared last week. We can see stocks still relatively listless, 0.3% gain after a 0.2% decline. Not really going anywhere on the S&P. NASDAQ had a little bit of a better week, up 1%, but still within familiar range bounds. A much more spirited performance in the bond market, yields cratering, down 3.7% in the 10-year, down 3.1% in the 2-year. Most of that happening courtesy of the U.S. jobs report, which we'll get to in just one moment. Crude oil still kind of doing its own thing, down 3.3% last week, but that's after an upswing the prior week and still kind of idling near the midpoint of its longer-term multi-month range, going all the way back to the middle of last year or so. So kind of off and away by itself, crude oil. Gold higher, again, 3.9% last week. The dollar, though, interestingly, holding up relatively well. Down only 0.1% against the euro for all of Friday's fireworks, and up a little bit against the yen, 0.4%. Bitcoin up 2.9% last week in all, but that's after a 6.9% drop. So over a 2-week period here, we get a large sell-off and a small rebound to retrace, but certainly the mood in Bitcoin still looking relatively heavy. Here's what we saw on Friday, thanks to that jobs report. S&P 500 down a little bit, 0.3%. NASDAQ flat. Yields taking a big hit. And, of course, we can see where those big weekly declines come from. Obviously, we can see that the lion's share of those moves seem to be on Friday. We likewise get a very convincing rise in gold again. The dollar is down 0.6% against the euro, 0.7 against the yen. Bitcoin gets most of its gains on Friday for the week, and the dollar would have had an up week across the board if not for these setbacks. So what happened with this jobs data? Well, we can see here that the headline number was vastly lower than expected. Only 22,000 jobs added, which is a pittance. 75K was the expectation, so it was already low, and now we've really undershot. The revisions were netting out to down 21K for the preceding month. So what have we learned here? Ostensibly that we added 1,000 net jobs in the latest iteration of the figures, which of course is not encouraging in the slightest. And the jobless rate in line as expected, 4.3%, still relatively low by historical standards, but also the highest since 2021. So that much came in as anticipated, but that headline payrolls number clearly caught the markets in a tizzy, and we had first the markets jumping to celebrate that this would mean that more rate cuts are coming. The S&P initially rallied, then selling off, and ultimately, as we can see here, ending the day with a small loss, whereas it had been a large one earlier. Markets apparently don't think that 1,000 net jobs added in a given month is a good thing, or 22K even isn't a good thing. Shock of shocks. This starts the smack of recession risk, and so the markets are displeased. Now, we talked all of last week about how U.S. economic data has actually tended to surprise on the upside recently. Certainly the ISM numbers were a case in point, as were, for the most part, the other kind of contemporaneous indicators. And so we get this jobs report that's clearly on the weak side. Maybe what we're looking at is delay in sort of the usual way that jobs data tends to be lagged. Maybe we're looking at a kind of pickup in activity that hasn't spilled over into the labor market. We've heard the Fed talk about how the labor market is in a kind of strange state here, where there's not really aggressive firings, nor is there meaningful hiring. We're in a kind of equilibrium approaching situation where there's not demand for new hiring that's really powering a strong increase in payrolls, nor is there a shedding of labor forces. And so there's almost a kind of standstill. And this data would start to show us that, especially over the past 3 months or so. Not encouraging, but certainly not anything that necessarily tells stock markets this or that thing, and ultimately it looks like that's why you get, despite a relatively strong showing for a bunch of other sort of Fed adjacent assets, obviously a strong showing for bonds, a strong showing for gold, a strong showing for currencies not named US dollar. That's why you seem to get this kind of soggy thing for stock markets on the whole. What's interesting then is that, at least on the rate side, the markets have clearly taken the hint. You can see now the likelihood that we don't get a cut is non-existent at this point, even a minor likelihood for next week's meeting. We're looking at a significant level of conviction at this point that there's going to be one cut, 88.2%. That there will be a cut of any kind is now a 100% likelihood, because there's now an almost 12% chance that we're going to get a 50 basis point cut this go around. Now, this much is probably non-controversial, at least that there's going to be some kind of a cut and that it's likely to be a 25 basis point cut. Markets have known this for quite some time at this point. Moreover, we can see that the way the markets are now setting up for this year and next, if anything, they're a little bit out on a ledge for next year now, having been essentially anchored around 50 basis points here since about the middle of May. Now we're slightly in the direction of a possible third rate cut this year. We've baked in 13 basis points out of that extra move from 50 up to 75. So about half of that move is now in the market. So we're basically saying, okay, we're about 50-50 chance on a third cut. But we've been at similar levels here, so it's not unheard of within this sort of range. But the Fed has been saying since December of last year that they're looking for 50 basis points this year. And we can see that the market has basically been anchored around that level, give or take some fuzz this or that way, since mid-May. Why is this significant? Well, we can see that at the beginning of the year, stock markets sold off and the Fed outlook got more dovish as we had this tariff rollout fuel concerns about economic growth. And we can see that right here. So this is a fear about the economy. In the dark line here is the S&P 500. Everything is going down at the same time. Now, you notice in early April, this is where you get Liberation Day and markets freak out. The president then comes out and goes, whoa, 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 90-day pause. The markets have gotten, quote unquote, yippee. And so the markets go, oh, okay, so I guess the White House is amenable to market discipline. I guess it does adjust what it thinks when the markets go haywire and signal you're doing the wrong thing. And so there is a sort of sentiment recovery. And you can see we come off the most dovish extremes here. Stocks do as well. And that takes us right into the middle of May. And this is where we get back to baseline, 50 basis points, as the Fed would have signaled it. Moreover, on stocks, we come back to the site of the break. So if this right here was the consolidation range near the top at the beginning of the year, and the break from that was somewhere around here, we'll look at where we come back to being just as we get this recovery here. And so what is that saying? Well, it seems to imply that whatever follows thereafter, once we get here, is no longer about an improving economic outlook or certainly a diffusing of the need for easing. Because we can see here for this calendar 2025, the markets basically return to where the Fed was at the beginning of the year. 50 basis points. This is where we started. This is what the Fed signaled in December. It's where the markets were before this move. It's where they come back to. But notice what happens thereafter. From there, it's the outlook for 2026 that starts to blow out. The sum starts to build out to a more dovish setting, and stock markets drift higher. So it seems like the rally for the better part of the past 5 months has been about little more, in this context, certainly. Surely there were some other influences too, but the most convincing story seems to be that it's about oncoming stimulus. It's about cheap money. And at this point, if we consider where we are numerically, we're already starting to exceed where that April bottom was. So, on the whole, the vulnerability here is the markets have become very dovish. The Fed is widely expected to do at least some amount of easing, so that much is non-controversial and probably not going to move the markets this way or that. The big question becomes, will they move their forecast? Which again, in June, had from 3.9 to 3.6 in 2026, just one rate cut. This is a move of 0.3, obviously rounded off from 0.25. This is a single move. Whereas for the Fed, in contrast with the markets, the gap is almost 50 basis points. A little bit more, in fact. And so this now sets up the risk in this Fed policy announcement coming out of last week, that the Fed isn't going to go the market's way. Now, why would that be? Well, maybe we'll find out this week, courtesy of U.S. inflation data. And we can see there's quite a bit of it on the menu. We already got an uptick in this survey of consumer inflation expectations, but the meat really is Wednesday and, of course, Thursday. Wednesday, we're going to get the PPI report. Thursday, we're going to get the CPI report. So this is wholesale inflation, retail inflation. And we can see here, we're expecting a relatively modest further increase in PPI, only 0.3% after 0.9% last month. The year-on-year figures here seen coming in a little bit, at least for the core, from 3.7 to 3.5. Headline seen holding unchanged. This will be very important stage setting for the CPI report to follow, because we've already seen in this PPI report this very significant jump in the July figures that told us we are now starting to see wholesalers really pass the cost of tariffs down to consumers. This mostly reflects rebuilding margins after this period of weakness here at the start of the year, where businesses basically said, we're going to eat the tariff costs. We're not going to pass it on to consumers. We're going to take the tariff costs out of our own profit margins, and we're going to insulate consumers lest we destroy demand for our own stuff without knowing what the tariffs are really going to do. Well, now it looks like they've decided they have enough conviction to say, you know what, consumers, you pay for it. And so margins have built back out, and so you get this sharp jump in wholesale inflation. We'll see if that continues to surprise higher in this go-around. And of course, if it does, it'll be good stage setting for this, the main story. The headline inflation rate seen going up from 2.7 to 2.9. The core rate seen holding at 3.1. We can see that here. If this were to surprise on the top side, then, of course, the likelihood that the Fed would meet the markets where they are on this expansive 2026 outlook would be significantly diminished. There'd be a lot of consternation, perhaps, about a Fed that surprises on the hawkish side, not because it doesn't cut, but because it doesn't endorse this expansive dovish outlook thereafter, beyond the calendar turn to 2026. And certainly, if the PPI numbers are hot going into the CPI report, the concern would be that this too would start to roll up and get the Fed into a more sort of concern about inflation becoming sticky were they to act with more conviction. And we see that in the sort of last bit of data here for the end of the week. We're going to get the University of Michigan Consumer Confidence Survey, and that's got an inflation expectations component, in particular this one-year inflation expectations component. It was 4.8 last time, which is a rebound. We'd started to come down from kind of April's peaks where there was that freak out around Liberation Day. That was a peak of 6.6. And we can see here that really since the COVID inflation scare reached its peak and the Fed started to really hike rates in early 2022, and until this tariff spook, the trend has been lower inflation expectations, improved consumer confidence, until we get into the beginning of this year. And it's here that we start seeing, tariffs, inflation expectations come back up, consumer confidence falls back down. We'll see how overall consumers' mood holds up. Of course, we've already had very weak consumption in the first half of this year, the weakest, in fact, the weakest 6 months since the first 6 months of 2020, which is the COVID recession onset. And so already there is a sense that consumers are feeling the pain, and the pass-through, as we just saw, is only just getting started. If that continues, then indeed we might have a further pickup in inflation expectations. The Fed would certainly worry about that becoming entrenched, and that could limit their scope for easing next year, at least in their mind. which would be at odds with where the markets are. And that, of course, creates a significant risk for stocks. I mean, if you thought that much of this was contingent on what's going on here, at least to some extent, at least let's say for half of the move, well, then you have a meaningful discount here if these expansive expectations are not met. And moreover, if we consider what the dollar is doing, it's of course a little bit down in the wake of the jobs data on Friday, but it hasn't made a lower low of consequence since the beginning of July. Meanwhile, as we just saw, gold is surging, bond yields are cracking lower in earnest. The outlook for the Fed is becoming ever more dovish, but the dollar strangely seems like it's done declining. It hasn't found the impetus for a rally. Certainly, if the Fed were to leave the markets hanging on next year's rate cut outlook, that would start to look like a reason for the dollar to go up in earnest, especially if it were powered by risk aversion as well as a rethink on Fed policy expectations. So we have a situation where the market seems to be sniffing out something. Maybe a turn in stocks, maybe a turn in the dollar, and this inflation data is going to be critical stage setting for what may happen then next week to really catalyze these changes. Outside of the US, we've got a monetary policy announcement from the ECB. We see here no changes being baked in. So the current rate here, the baseline deposit rate stuck at 2, and we can see through the rest of the year, these month-based Ionia futures are telling us we're shy of 1.75. In other words, there's no cut that's baked in, and we can see that here. The change here, only about a 5 basis point cut that's baked in. For next year, again, a pittance, only about 8-9 basis points in a cut that's priced in for next year. In other words, we're looking at stasis on ECB rates. We'll see what they say. We'll see how that influences the equation here. But of course, it's coming out the same day as the CPI report. So this might be something of a non-event this go-round. We're also going to get a bit of data out of China, in particular the inflation report coming on Wednesday ahead of PPI in the US. So perhaps we get a little bit more maneuver there. And what's interesting is that year on year, we're still expecting ongoing deflation for wholesale prices, but for CPI, we're expected to come in from flat to, again, negative 0.2%, essentially saying there's no demand to speak of in the world's second largest economy still. It's now been mired in economy-wide deflation for 9 consecutive quarters. There's been some stirrings of activity, perhaps, but consumers over there still seem perfectly content to stash their money into savings accounts, and there's really no demand to speak of to power the economy forward. So if the U.S. economy were to falter, we really don't have a plan B. Europe is at standstill, as evidenced by stasis at the ECB, among other things, and China still can't get the engine revving, going on 2 years now. So as we look at what's going on then, it really is all about the U.S. Over the weekend, we had some data out of China on the trade side, which we can see gave us cooling exports and imports. So it really is about the Fed. It really is about the U.S. economy, because without that, we don't really have much of a global business cycle catalyst to speak of. As far as positioning goes, still familiar exposure, not really much to update here. Still long the dollar, looking for it to bottom, long it against the Aussie, so short that. the pound, the euro, and the Canadian dollar. Still looking at long gold, short the put there in GLD at 330, and of course it's working a bit here. Short a bit of Bitcoin. These puts very cheap, and so looking for that to essentially be a little bit of a kicker on this general risk-off bias, looking for stocks to maybe start to look for a top here, or at least the risk-reward on that to look attractive. So still holding these put verticals in the NASDAQ and the S&P 500, and enjoying the rebound in bonds. This is finally working. I was sitting in these positions for 2 months before there was any kind of movement in them, but these call verticals in the long end of the curve finally working, and no reason to get off the boat now, much like gold, until at least there's some kind of a downtick. And that is macro money for today. As ever, here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.